Imagine a group of very rich people.
They look at a company and say, "This will fail," so confident. They bet huge money on it failing. But instead, the company survives, then grows, then explodes, and the rich people start losing a lot. This is the story of Tesla. Before it was cool, before it was big, when Wall Street was sure it would die.
And how regular people accidentally trapped hedge funds in one of the most painful short squeezes ever.
Tesla makes electric cars. That's it. Cars that don't use gas.
Cars that run on batteries.
Today, that sounds normal. But years ago, people laughed. They said electric cars were toys. Slow, ugly, impossible to scale. Wall Street didn't see Tesla as a car company. They saw it as a bad idea. Here's a simple way to understand it. Imagine you borrow your friend's toy. You sell it for $10. You promise to buy it back later for cheaper, maybe $5. Then you return it
And keep the extra money.
That's called short selling. Hedge funds did this with Tesla.
They borrowed Tesla shares,
Sold them, and waited for Tesla to crash. They were sure it would. Tesla was losing money. It missed deadlines. Factories struggled.
Cars had problems.
Elon Musk tweeted too much. Slept on factory floors. Acted unpredictable. To hedge funds, this looked perfect. A weak company. A strange CEO. Lots of bad news. So they went all in. Tesla became one of the most shorted stocks in the entire market. Wall Street thought this was easy money. But something unexpected happened. Regular people started buying Tesla stock. Not hedge funds. Not banks. Engineers. Fans.
People who believed in electric cars.
They didn't care about Wall Street opinions. They saw the future. They said, if Tesla works, this changes everything. And instead of selling, they held. At this point, two stories existed.
Reality 1: hedge funds. Tesla is burning cash.
It will run out of money. The stock will crash.
Reality to believers. Tesla is building the future.
Factories take time. Growth comes later. Both sides were watching the same company, but seeing completely different things. As Tesla kept surviving, something dangerous happened. The stock price didn't fall. It slowly climbed. That's bad for short sellers. Because remember, they must buy the stock back eventually. And the higher the price goes, the more money they lose. Some hedge funds started feeling pain. Others refused to quit. They said, it's just a bubble. Here's the kid version. If many people owe the same toy, and the toy becomes rare, everyone rushes to buy it back at once. That panic pushes the price higher. That's a short squeeze. With Tesla, this started slowly, then faster, then violently. Tesla hit milestones. More cars delivered, new factories, better batteries. Every small win pushed the stock higher. Hedge funds began covering their shorts,
Buying shares to escape losses.
but their buying made the price go up even more, which hurt the remaining shorts. A loop formed. Why price up, panic more buying? By the time Tesla's stock truly exploded, something shocking happened. Hedge funds had lost tens of billions of dollars betting against Tesla. Some funds shut down. Others quietly exited. Tesla didn't just survive.
It punished disbelief.
This wasn't just about Tesla. It showed something new. When enough people believe and refuse to sell, even the smartest money can be wrong. Markets aren't just numbers, they're stories. And sometimes, the story wins. Tesla didn't squeeze like GameStop. There was no single explosion. Instead, it was a slow crush. A reminder that betting against the future is dangerous. So the real lesson isn't, should you buy Tesla? It's this: what happens when Wall Street underestimates belief? Because once people stop listening, even giants feel small. And once a squeeze starts, someone always pays the price.